What up, Hyperchange? Welcome to another episode. Today I'm talking about the Netflix of yoga, Gaia, ticker's G-A-I-A. This is a tiny little company from Colorado that has been focusing on a streaming video on-demand service just like Netflix's, but theirs is a specialty niche focus on yoga, consciousness, mindfulness, and meditation. Shout out to Mark, Hyperchange subscriber. Thanks for the idea. Also, I think it's funny to note that my mom is a subscriber. She loves it and watches it every morning and does yoga with it. Fun little fact. The service costs $9.95 a month, just like Netflix. Now let's walk through the investor deck so I can get you guys a little bit of a better flavor about the business. They're a global video subscription service. They have over 8,000 original programs and curated videos. That's a number that's growing every quarter as they're investing in original content, very similar to Netflix. 93% of their content's exclusive. This is my favorite part about the company, and what really hooked me is their founding team. Jirka Raisavi, who is the founder and now CEO of Gaia, has an incredible track record. He's a very fascinating entrepreneur. He led a company called Corporate Express to a multi-billion-dollar exit, grew their revenue at 100% for several years. Before that, he ran Crystal Market, which sold the Wild Oats Market, which is now Whole Foods. This guy has a track record of executing and big payouts for shareholders. He brought along the head of e-commerce at Corporate Express, the company sold for billions of dollars, who's also the CEO at Gaia. So just great synergies here, bringing along the team. I love to see this. Also, Jirka has a 38% ownership of Gaia. He's incentivized to get this thing to the top. That is one of the first things I look for in a microcap company. How much stock does the CEO/founder own? Check in the box with a massive amount, 38% equity stake. This should be no secret to you. Growth in over-the-top revenue, the category that they're competing in, is just astronomical. This is a business that was only $4.5 billion 7 years ago, was $37 billion last year, and is catapulting to over $100 billion in the next 10 years. The amount of homes that are going to have these type of streaming services are growing as well. So they have a big international strategy, even though they're super small with only about less than 300,000 subscribers as of the last quarter. Those subscribers are already across 150 different countries. They launched in Spanish in July 2017. They're going to keep launching new languages. This is going to be a key part of the company's growth strategy, as they really are committed to the fact that their platform has global appeal. They eventually think that more than half of their users are going to be international, so that's something to watch out for. In their projection of the market opportunity, they assume that if there's 428 million global top subscriptions, they can be catered to about 7% of those, or nearly 17 million. Remember, these guys had under 300,000 subscribers last quarter. They're telling you the addressable market here is 10, 20, 30, 40, 50 times as big as it is today. And I actually kind of believe this. You know, the trend of people getting healthier, of wanting to take charge of their body and doing meditation and yoga. I started doing yoga a couple years ago. I'm not a Gaia subscriber, but I'm getting more into that culture, and I think that's just a trend that's going to keep continuing. Gaia is a fascinating way to not only play these over-the-top streaming services and this revolution in content, but also a way to play the rapidly growing trend of health, wellness, and mindfulness that they kind of encompass in their product. Fascinating little story going on with the company. Gaia has not been a pure streaming play for that long. In fact, in mid-2016, they spun out this whole apparel division, which was selling branded yoga mats and yoga clothes and things like that. Got a massive 100+ million cash infusion from selling this business at a profit. They used a huge chunk of that cash to buy back about 40% of their outstanding share count. This was a tender offer done at a premium to the market price. Then they've used the extra amount of that cash, about 60 million left, went straight to their balance sheet. This is a company with no debt, and they've been funneling that cash into rapidly growing their streaming video service. Kind of an interesting transformation. I think that's why these guys are a little under the radar. The financials are tricky because this spinoff only happened about a year ago, and now they're looking like they're losing a ton of money because they got this mega cash injection, and they're just putting it all into marketing, spending it cognizantly. I would argue they've been putting up the numbers to prove that this is a pretty good strategy. Their year-over-year subscriber growth rates accelerated from 46% to 64% in just 3 quarters. They're targeting 70% growth and then 80% growth in the following 2 quarters, and their goal is to grow by over to 1 million paying subscribers by the end of 2019. They're telling you in the next 2.5 years, they are going to triple their subscriber base. So these guys are not shy about big growth projections. I have no idea if we'll hit them, but they've been putting up numbers recently. Once again, Jirka, he's the CEO who's grown companies from several million to billions in revenue, exited at a huge profit to shareholders. That's exactly what he's telling you he's going to do here. They also think they can do pre-tax income kind of like operating income of 40% of revenue in 4 years. They're telling you this is going to be an incredibly profitable business as they start to hit scale. Of course, they're going to say that. We'll see if it happens. Just like Netflix is creating original content, so is Gaia. They actually have a 12-acre, 150,000 square foot campus that is worth about 15 to 20 million that they own outright. Remember, this company has no debt. They have full ownership of this $20 million, 12-acre mega campus, which they're using to produce original content. 80% of the viewership of their members on their platform is original content. On 93% of the content, they have exclusive rights, so they're not dependent on other studios. Even though they're tiny, they still have the capabilities to vertically integrate and produce original shows. Let's dig into the financials. And although the growth has been strong, it's tricky to know exactly what's going on in the business before 2017. If you look at the streaming and DVD part of their business, which is now the core business that Gaia has, a really strong growth business already for the company, growing from 4 million to 17 million in 2016. And what's driving this growth, as you can see, is just the streaming revenue is going astronomical. They still have a little bit of DVD revenue, which has actually been slowing their top line growth. Funny to note, this is almost exactly like Netflix, where they kind of have the lingering dying DVD business and this rapidly growing streaming piece on top of it. But these are the financials. Now, remember, they tried to separate out these numbers with the spin out, but I don't know exactly how accurate they are, but they're from the 2016 10K, which I'll link to in the description. And as you can see, the operating losses are just, the margins frankly suck here. They lost 17 million on 17 million in revenue. Growth is strong, but they're just losing more and more money. So this is a trend that totally needs to change if you're going to be a believer in the company. What I've charted is their subscriber growth in the last 4 quarters with management's guidance in the next 2 quarters. This is incredible growth. In just the past year alone, we've seen subscribers more than double from 117,000 to 278,000. This is why in the last 4 quarters with that incredible subscriber growth, we've seen quarterly revenue really take off. And in the last quarter, it was up 65% from 4.2 million to 6.6 million. But once again, losses continue to mount. So even though they're growing rapidly, we're not seeing any operating leverage in the business. And I'm not convinced that this is a bad business because they had this huge cash injection. So they're spending money up front to acquire all these customers, which are going to pay them recurringly over time. So even though the losses look dramatic now, they're telling you that even if they stop spending, they could be profitable almost overnight. And it's fascinating to note that in their investor deck, they even have a point that says, we could be profitable at any time with 90 days notice. Major recession hits, we need the cash, we can just stop spending and go profitable on the flip of a dime and still be growing at a solid clip, even though it would be much slower. Don't know if I believe this. And this is the kind of hang up that I have right now in the company, because I think they're an awesome niche. Everyone that I've talked to that uses the product loves it. They're showing tremendous growth. The question is just, can they do it profitably? Now is sort of the break moment from the company. If we look at the first half of 2017 financials versus first half of 2016, the losses are massive, but revenue is up 65%. But, I'm still not convinced. Loss almost doubled. What's going on here? My guess is that they're going to start curbing or capping their spending soon because they've whittled their cash down from 60 million to 36 million. Remember, they have no debt, so pretty clean balance sheet. They need to rein in their spending to make this cash last longer and really show a significant improvement in operating margins to convince people of the bull thesis. With all that being said, I've estimated what I think they're going to do for 2017 revenue, about 25 million. They're going to lose about 25 million on that, but remember, that's because they're pushing all this money into marketing. So what do I think we need to do to really get convinced of the bull thesis? Well, I put in my 2018 projections an acceleration, have revenue hit 38 million. This is a slowdown from the current growth rate they're doing. It looks like a crazy jump, but according to management's guidance, this is about right on track. I'm expecting they need to curb their spending to only lose about 15 million. This means they would run out of cash at about the end of 2018, but starting to get towards break even. I frankly think the company's going to need to raise capital either through a secondary or take on debt to be able to fund their growth to profitability, because I just don't think they're going to get there yet. And so that's something to watch out for. But remember, the founder, Jerka, owns 38% of the company. So he is heavily incentivized not to dilute, to only raise capital if it's really, really, really necessary. The biggest risk for this business is that Netflix or Amazon starts producing content in this yoga, mindfulness, meditation niche. But I also think they have the niche here, they have the expertise here, they have the facility to produce original content. You could also make just as much of a compelling case for Amazon or Netflix to buy the company out. Now let's talk about the company's valuation. With a current about 16 million shares outstanding and about $12 per share, we're looking at a market cap of 192 million. This is a company that's on pace to do 25 million in sales this year. That's a current price sales ratio about 7.7x. Based on my revenue estimate of 38 million next year, they're only trading at about 5 times 2018 sales. Based on Netflix's price today, they're trading at about 6 or 7 times 2018 sales. Gaia's only trading at 5 times, yet they're growing about twice as fast. And the reason behind this is all profitability. There's They're losing so much money. I don't think the market's convinced that they can do this and grow the business into a profitable entity, even though management's telling you they can. We're kind of at this rubber meet the road moment for Gaia, where if they can start to show a huge improvement in operating margins, keep this growth up, then I think the stock has big upside, because you're going to see them trade at a very high price sales multiple that these streaming pure play companies demand. A crazy little company. I think they have an awesome product, awesome niche. That's Hyperchange. I would love to know what you guys think. Also, I'm wearing the SpaceX tee today. Shout out to Jacob for sending that. We did a tee trade. Oh, and there's still a couple shirts on hyperchangetv.com for you guys to buy, Hyperchange merch. Anyway, happy meditating. Get on with your yoga this weekend in the spirit of Gaia. That's Hyperchange. See you guys next time. Peace.